progress.
Good afternoon. Today we're gonna start chapter 11 about trading strategy involve options. We're gonna have the second exam next week. I posted the information about the exam on my course, so please log on my course, and I have a formula sheet, review sheet on over there. The test will be Wednesday, and Monday I'm not gonna have any meeting, no Zoom meeting on Monday. So it's time for you to study, and you're gonna see all the homework and the solution for the homework. So you please, I'm gonna grade all the homework. Try to complete the grading by Monday, so you can study with the solution, and the test will be Wednesday. The format similar to what we did in the first exam. So you're gonna have 5 multiple choice question and 3 comprehensive question. You need to finish in 60 minutes. So that's my expectation. So which is assume you study well. If you didn't study well, you may not be able to finish. Okay. Question? Today we're gonna start. We're gonna study chapter 11. Trading strategy involve options. Can you see my shared screen?
Yes.
Yes. Thank you. Thank you. So trading strategy. So far we talk about the option. We covered option, the basic option. For example, option position, type of options, and then we talk about the and then we talk about the option, the lower bound, upper bounds, and the arbitrage opportunity strategy. Arbitrage opportunity strategy, and this chapter we're going to talk about the trading strategy involve options. So first, we're gonna in this chapter we're gonna cover bond plus option, stock plus option, and then we're gonna talk about the options, which is 2 or more options of the same type. We call it a spread, or 2 or more options of different types. It's a combination. So which is the call and the put combined together. Okay. So this chapter we're gonna discuss the profit pattern. So we're gonna focus on the profit pattern. Profit pattern when option is traded in conjunction with other assets. Other assets could be stock, could be bonds, could be options. The choice of a trader make depend on the trader's judgment about how the price will move and the trader's willingness to take a risk. So when the stock price gonna go up, so the trader might think about the call, right? If it's going down, they're gonna think about the put, okay? So first, let's consider bond plus option. So bond plus option, also called the principal protected notes. Principal protected notes. In this strategy, they include a 0 coupon bond plus option. Okay, so 0 coupon bond, which is the no coupon payment, but for sure you will get the principal, right? So investor who think that the price of the assets will decline, they're gonna buy a what? They're gonna buy a bond plus a put option because they think about the price gonna going down. If it's going up, you're gonna buy a call, right? So that's the expectation about the price, stock price, the bond price. The payoff is the what? The principal of the bond, because this is for sure you're gonna receive at the end, plus the payoff from the option. So if any, so could be like 0, right? If like a trader will not exercise the option, so it would be 0. Otherwise, they have a payoff. And that's bond plus option. Now let's see stock plus option. Stock plus option. Portfolio consists of a long position in the stock and short position in the call. So basically it's S minus C. S minus C. This is called the writing a covered call. Okay, this is called the writing a covered call. This portfolio, this is one strategy. The other strategy is long a position in the stock. Okay, long position in the stock and long position in the put, S plus P. This is called the protective put strategy. Okay, protective put strategy. So this is just 2 examples about the stock and the plus option strategy. The figure you can see in this next slides. In the next slides, A. So this is the S minus C. S minus C. So the figure 1 shows S minus C writing a covered call. And the figure C shows S plus P. So in the slides, you can see the two lines. One line is this is about S, long position on the stock. So you see when stock price going up, there's a straight line. And if you take short position on the call, you see this is the for the call. And combine these two, you're gonna get the profit. The diagram is like this. So from this graph, you can see when stock price going up, you have a maximum gain, right? You have a maximum gain, and the maximum loss would be what? Basically, maybe the premium you paid at the beginning, and for the protective put strategy is as longer position on the stock and the longer position on the put. So combine these two lines, you're gonna see this is the line. So there is the maximum loss, right? Protective your loss, so you won't have a loss below this. And you have a max. You don't have maximum gain. You have unlimited gain, right? You have unlimited gain. So this is good, right? This is good. And you can do reverse. So this is B and D is reverse to cover the call and the protected put. So which is reverse. And from the combine of the two line, you can see, so this is basically the C minus S, and this is the negative S and minus P. So that's called reverse. And for figure B, you can see when the stock price going up, the maximum loss, right? This is maximum loss. And price going down, you basically have a positive gain, right? Have a positive gain. So here the positive gain. And for reverse of protected puts, you can see they have a maximum. When stock price going down, they have a maximum gain. They have a gain, right? But when stock price going up, you're gonna have a unlimited loss, right? This is the risk very high, right? Unlimited loss. Okay, so for the stock plus option, we just had two examples. Okay. Next, we're going to focus on the option combine, which is the first. We're going to talk about spreads. Spreads, which is involve taking the position in two or more options of the same types. Okay, so which is C, one type of C plus another type of C, or one type of P plus another call on another put. So they are not combined together, just the same type. Okay, so example, bull spreads and bear spreads. So first we're going to talk about bull spreads. What is bull spreads? The bull spread, which is buy a call or put, okay, not the same time, buy a call, say buy a call with the lower strike price and sell another call on the same stock with the higher strike price. So two calls, the difference between these two calls is what? They have different strike price. Two strike price, the strike price difference for these two call, or you can change call to put. So that's called the bull spread. We can call it buy low, sell high. Buy low, sell high. We can call it buy low, sell high. We can call it buy low, sell high. A bull spread strategy basically limits the investors' upside as well as downside risk. Okay, so if you draw the return pattern, profit the pattern, you're gonna see they might look like this. So for the lower and up, they have limits, right? So which is the limit up upside and the downside risk. Investor have a maximum gain and loss when stock price going up or going down. Okay, so we're gonna have example, and the examples you're gonna be able to figure out the profits for different case and be able to draw the profit pattern. Okay, so before we talk examples, here are like what we learned before, and it's just a review. So the profits from spreads, because we have you buy call and sell call, right? So you're gonna long call and short call. So the profit for long call calculated by what? For call is ST minus K, right? Maximum value between ST minus K and 0. And since you take long position, so minus C. And if you take a short position, make sure negative and plus C. Okay, for long put, the same thing. And difference is what? K minus ST. And the short put is negative K minus T and 0. Maximum value between these two and the plus P. Okay, so this is this formula. You don't need to memorize. They are on the formula sheet. So, but you need to be able to use it. Okay, for the spread, normally we have two call. So let's say C1. Let's say call C1 and C2. You buy C1 and short C2 and sell C2. So it would be C1 minus C2. So you might need to know spread. Basically consider a long call and the short call. Okay, so basically two call. Same thing for put. Okay, let's see example. Example 1. Any questions so far? Okay, so invested by a $3 buy. Okay, so this is one call long, $3. So C1 equals 3. With the strike price, let's say K1. Let's call 1 means the first call, the first option, call option. So K1 is 30, and the sell, which is C2. C2 is $1. Okay, C2 is $1, and the strike price is what? K2 is 35. So buy low strike price call option and sell high strike price or call option, right? So this is called the bull spread. What are the profits from this bull spread strategy? And draw the graph on the profits. Okay, so first, we're gonna need to know what's the profit for long call. The long call, the profits calculated by maximum value between ST minus K, right? ST minus should be K1 because long call, the first call we buy is number 1. And you take a long position, so you need to pay C1. Okay, and we can plug into the number we know. We don't know ST, so we put ST there. K1 we know is 30, and the C1 we know is $3. Okay, that's all. And the profits for short call. For short call, remember we put negative in front of the maximum value for short, and ST minus now is 2, K2, right? Because we consider the second call, the call option is C2, and you receive, because you take short position, you receive C2. So next maximum value between ST, we don't know, but K2 we know is 35, and 0 plus the C2 is what? C2 is 1. Okay, so that's profits for two options we know. And for the whole strategy, for the whole portfolio, we just add together. Okay, so next we're gonna figure out the profits. But since we don't know ST, right? We don't know ST, but if you draw the timeline, we know one strike price is 30 and the other is strike price is 35. So two options strike price. So ST could be below 30, could it be between 30, 35, could it be greater than 35, right? So three case, we're gonna consider three cases. So first, when ST less than 30, okay, or equal 30, that's fine. The profit for the whole strategy equal. So first we consider the long call. So when stock price less than 30, ST less than 30, anybody can figure out what's this number? ST less than 30. So ST minus 30 equal or greater than 0 or less than 0?
Less than 0.
Yeah, less than 0, then we take 0, right? So maximum value, we take 0. So 0 minus 3, okay? That's for long call. And then we consider short call. Short call, let's do again, minus ST minus 35. ST less than 30, ST minus 35, again, is negative value, right? So we take 0, which is maximum value, and the plus 1. Okay, so the profits when stock price less than 30 would be negative $2, right? Negative $2. That's case 1. Case 2, when stock price between 30 and 35, the profits for the whole strategy, for the long case, when stock price greater than 30, then ST minus 30, is that positive or negative? ST greater than 30 is positive. Yeah, so positive. So we're going to take a positive. Okay, so ST minus 30. Because this is greater than 0, so we're going to take this value and then minus 3. Okay, for short position, ST minus 35 because ST less than 35. So ST minus 35 again is negative value, right? So negative value, we're going to take 0. So minus 0 plus 1. So in the second case, when ST between 30 and 35, we get the ST minus 30 minus 3 and plus 1. So 33 plus 1, 32, right? So ST minus 32, that's the profit when stock price between 30 and 35. Okay. And the last case, when stock price greater or equal 35, the profits should calculate the, let's see, when for the long call, ST minus 30, because ST greater than 35, so ST minus 30 still positive, right? So we take a positive value, ST minus 30, and then minus 3. For the short call, ST greater than 35, so ST minus 35 is positive, right? Because ST greater than 35, so we take this number, this is a positive number. So when you do this calculation, make sure here is negative. When you do take out, make a parenthesis, okay? Make a parenthesis for the whole value, ST minus 35 and the plus 1, okay? And then we do ST minus 30 minus 33, that's ST minus 33, right? Minus 30 minus 3. And then minus ST here, minus 35, and the negative would get the positive, right? 35 and the plus 1. So what's the answer?
Is it positive $3?
Yeah, that's correct. So $3, okay? So we finished what are the profits from this bull strategy. Okay, so we done that, and then we're gonna draw the graph for the profits. The graph for the profit, we should the left hand, the x-axis should be the price, right? ST. ST, and the y-axis is the profit. When stock price less than 30, okay, let's say this is a 30. When stock price less than 30, the price is -2. Okay, it's -2. When stock price greater than 35, the profit is $3. Let's say this is 3. So between 30 and 35, we just need to link these 2 points. Okay, you see this slope, the line between 30 and 35, this is positive. You can see ST is positive, right? See this case, ST is positive, so which is the positive, which is upward sloping. Okay, so this is basically the bull spread strategy for call. Okay, bull spread strategy for call. You can see the strategy limits upside risk, also limit the downside risk, right? So it's the maximum value, the maximum profit is $3, and the minimum profit is $2, -2. So that's the this is the bull spread for call. Question? Question? So the your assignment and your test, what I expect you to do is like this. So you need to first show the profits for each position, and then consider a few case, 3 case, and figure out what's the profit. And based on the profits, you can draw the graph. Okay. Question. So you can see after each class, I'm gonna I just upload the slide with the solution. So if you missed any notes, you can check the slides with the solution. Okay, so this is the bull spread using call. The example 2 is talk about the bull spread using put. I would like you try it a little bit, and then we talk about together. Okay, so everybody please try. I'm gonna ask the student to tell me what did you get. Okay, investor buy for, so buy is long position, buy a $2. So this is the put. So this is the P1, right? P1 equal $2 with the strike price K1 is 26, and the sell. So take short position. P2 is $4, and the K2 is 29. So you see the buy low and sell high strike price. So this is the bull strategy. And what are the profit for this bull strategy, spread strategy, and draw the graph for the profit. So first you need to figure out the profit for long put, right? And the profit for short put. Remember the formula in the slides, you can find it. K, here is K1 minus ST and 0. And you need to pay P1. And if it's short position, make sure negative. Make sure negative. Maximum value between K2 minus ST and 0 plus P2, right? And the K1, P1, you can plug in. K1 is 26. And the P1 is $2. And the short position, K2 is 29. And the P2 is $4. So if you draw the timeline, basically 2 strike price, 26 and 29. So consider lower as stock price below 26 or between 26, 29 or greater than 29. So you can consider 3 cases, right? When stock price less or equal than 26, the profit, you can calculate, or stock price between 26 and 29, calculate the profit. When stock price greater than 29, the profit. So you continue, okay? Let me know if you have a question. Anybody get finished or? I'm
For
gonna,
ST is less than 26. I got ST minus 27.
ST minus 27. I think it's not correct. Can you try
Okay.
that again? Yes, please.
Yes.
We can do it together. ST is less than 26, so 26 minus ST. So 26 minus ST, this should be positive, right? Because ST less than 26. So 26 minus ST minus 2, that's long position. And the short position, let's see. ST less than 26, so less than 29. So 29 minus ST, positive again. So minus 29 minus ST. This is the positive value. We use parentheses because there's negative in front and the plus 4. And you do calculation, ST can cancel because negative is positive, right? So ST can cancel. 26 minus 20 minus 2, 24. 24 minus 29 plus 4 equal what?
Professor, how about
Yeah.
the short put? There's a negative max. So where did you put the negative in?
I put it here. Here. Where is it? Here, right? Are you talking about this? Negative?
Yes.
Yeah, so here's negative, here's negative. Right? Because take short position, so we consider that. Put a negative in front. Is that right? Did I get it right? -26 minus 2.
I had the same thing, Professor.
Okay, good. So answer is -$1, right?
Yes.
Good. Okay, let's continue. If stock price between 26 and 29, so 26 minus ST would be ST, because ST greater than 26. So 26 minus ST would be negative value, right? Because ST greater than 26, so we're gonna take 0. For the second case, the -2, and then minus, because ST less than 29, so 29 minus ST still positive, right? So we're gonna keep that, and the +4. So what the answer for case 2?
The answer is ST minus 27.
ST minus 27. Yes, ST, you see negative would be positive, right? So -2 minus 29, which is minus 31. 31 plus 4, so minus 27, right? Yes, that's correct. Okay, and the last case, stock price greater than 29. So for the long put, 26 minus ST would be negative value. So we take 0, 0 minus 2. And when stock price greater than 29, then 29 minus ST less than 0, right? So we take 0. So that's easy. And the +4. So the answer is $2, right? Yes. So you see, call and put are basically very similar, but for the minimum and the maximum profit, they're just opposite. So let me draw the profit diagram. So the profit diagram, again, the x-axis is the stock price ST, and the y-axis is the profit. When here we have a two strike price, one is 26 and the other is 29. And when stock price less than 26, they have a minimum, the lower, which is -1. -1 when stock price less than -1, and when stock price greater than 29 is positive or similar, right? Similar for the call. So when stock price greater than 29 is $2 positive. So if you link this two, so that's the boost strategy. That's the boost strategy using puts. You see they're pretty much similar. So when stock price very low, they're gonna have a maximum loss. When stock price very high, they're gonna have maximum gain. Okay, so that's called the bull strategy, bull spread strategy. Question?
No questions.
Okay, good. So see, in the slides, in my slides, I have the procedure to solve the problem. First, you need to list the profits, okay, for either position, and then based on what we are given, and figure out the three cases when stock price less than 26, between 26, or greater than 26, you'll be able to figure out each case for the profits. So I think as long as you do the calculation carefully, you should be able to get the answer. Okay, just do careful work. You should be able to solve the problem. And you see the profit, the pattern is similar, right? For the bull spreads, using either call and put, you will see when stock price lower, they have a minimum, maximum loss, and when stock price higher, have maximum gain. Okay, so the bull spread strategy basically limit downside risk and limit the upside risk. So far we basically talk about the bull spreads, and another example for for spread strategy, which is called the bell spreads. Bell spreads. What difference between these two? Bell spreads is also talk about the buy or sell the same type of options. So bell spread, which is the buy a call or put with the higher strike price and sell another call or put on the same stock with the lower strike price. So in this case, I summarize that is buy high, sell low. You see? When we talk about bull spread, that's buy low, sell high. But for the bell spread, it's buy high, sell low. Okay? Buy high, sell low. So why? So why some investor like buy low, sell high, and some investor like buy high, sell low? That's because of expectation about the stock price in the future. They are different. Okay. Bell spread strategy also limit investor upsides as well as downside risk. So for bell spreads, the profit diagram would like this. Okay, so when stock price going down, you're gonna have maximum gain. When stock price going up, you have a maximum loss. And when we talk about bull spreads, which is buy low, sell high, you get the profit diagram is like this. So they have different expectation, right? So in this case, when stock price going up, they expect the gain, and for the bell spreads, when stock price going down, they expect the positive gain, right? So just the opposite expectation about the price. Okay, so for bell spreads, investor have a maximum gain and loss when stock price going down and going up. So you see, when price going down, they have a maximum gain. When price going up, they have a loss. Okay, so that's the difference between bull spread and the bell spreads. I think we have time to go through one more example. Example 3, investor buys for $2 a 3 months call with the strike price of $25 and the sell. Okay, you see, buy a call. So this is the C1 equal to, and with the strike price K1 equal 25, and sell. So the short position on the C2 call price is $4 and the strike price is K2. K2 is $20. So you see, buy high, sell low, right? Buy high, sell low. What are the profits from this bell spread strategy? And draw the graph on the profit. So similar to the first 2 examples we talk about. So we're gonna first figure out the profits. Profit for long call and the short call. So for the long call, we do maximum value between ST minus K1, right, and 0 plus C1. So we know K1, we don't know we don't know stock price, expiration date, but we know K1 is 25. And the C1 is $2, okay, that's what we know. And we do the same thing for short call. Let me ask a student, can you figure out what the profit for short call?
Would it be the negative max of ST minus 25 and 0 minus 2?
Plus 2, okay.
Plus 2.
Yes, that's cool. That's correct. So negative maximum value between ST minus K2 and 0. Oh, I mean, I made a mistake. Here is minus, sorry. Because you take long position, you need to pay the call price. And here the plus C2.
So it'd be plus 4.
Yeah, right.
Okay.
Yeah, thank you. Yeah, that's correct. You make sure the short position take a negative maximum value between ST minus K2 is 20. Yes. And 0 plus 4. Good. Okay, so once we figured out that, and then you can draw the timeline, see the strike price, we have 20 and 25, right? So again, we have 3 cases. We're gonna talk about 3 cases when stock price less than or equal 20. The profit for the strategy should be what? First, long, when stock price less than 20, so ST minus 25 is positive or negative?
Negative, so we would use 0.
Yeah, that's correct. So we're gonna take 0 because ST minus 25 is negative value. So 0 minus 2, that's for long call. And short call, because ST less than 20, so ST minus 20 equal less than 0, right? Again, 0 plus 4. So when stock price less than 20, the profit is what? $2, right? When stock price between 20 and 25, the profit equal what? Stock price still less than 25, so ST minus 25, this is what? Still less than 0, right? Can you do that? So you finish that. Case 2. Anybody get the answer? So you can compare your work with mine.
Is it negative $1?
Now we have ST here. So should it be, here is a positive 20, 24, 22, 22 minus ST, right? So because we have ST, we cannot cancel out. So we have keep a ST there. And the 20 plus 4, 24 minus 2, 22. Okay, so that's case 2.
Professor,
Yes.
would negative ST plus 22 work as well?
Negative 20.
Negative ST plus 22?
Yeah, that's correct. That's the same thing. Yes,
Okay.
you can put the ST negative T plus 22. Yes, same thing. You can do that way. Good. So when ST greater than 25, the profit, in this case, ST greater than 25, so the long position, ST minus 25, that's positive value. And a minus 2, and a minus ST minus 20 plus 4. So tell me what's the number you get?
-1.
-1. Let me see. So 25 minus 2, 27, negative 27 plus 27, 7. Is that -3? Can you check it again?
Yeah, it's -3.
Okay, good. So if you get this, then we're done, and we can draw the diagram for the profits. So x-axis is the stock price and y-axis is profits. When stock price less than 20 or 25. So less than 20, we have a positive $2 maximum gain. And when stock price greater than 25, we have negative $3. So the diagram just link between these two. So that's between the profits. So you see, when stock price lower, you're gonna have a positive gain. When stock price higher, you basically have a loss, right? But you have maximum loss. Okay, so this is the bell spread strategy for call. Any question? No question. Then we're gonna stop here for today. And the next class, we will continue finish the slides, and we probably have a time to review the test a little bit. Okay. So that's all for today. You can start to work on your assignment. I think 4 questions, you should be able to do 3 of them. Okay. That's all for today. Any question?
Thank you very much, Professor.
Yeah, sure, no problem.
And the exam is next Wednesday, correct?
That's correct.
Okay.
Yes.
Thank you very much. Have a great day.
You too, you too. So we're gonna talk about more about test Wednesday, this Wednesday, okay? So see you guys. Any question, just email me, okay?
Okay, thank you.
You're welcome. Bye. Have a nice day.